Have you ever looked at the global markets on a single day and thought, are these guys even on the same planet? Well, that's exactly what happened in late September. In the US, you had this unstoppable rally. But in India, it was a totally different story, a relentless slide. So, what was going on? Let's dive into this tale of two markets. And here it is, the perfect snapshot of what I'm talking about. On the left, you've got the US market, where pretty much every single sector was crushing its historical average. And on the right, India, stuck in its sixth straight day of losses. You couldn't ask for a clearer picture of divergence. So, you gotta ask the question, right? How on earth could two of the world's most important economies be sending such wildly different signals on the exact same day? Let's unpack it. Okay, first up, let's head to the US and figure out what was behind this incredibly resilient, almost unshakable rally. So on September 26th, the S&P 500, the big benchmark for the US market, closed up over 0.5%. Now I know what you're thinking, 0.5%, big deal, but hold on, because context is everything here. Get this, the historical average gain for that specific day is just 0.02%, barely a blip. So the market wasn't just up, it was up by a factor of almost 30 compared to what it normally does. That's a huge outperformance. And listen, this wasn't just a few big tech stocks carrying the team. The strength was everywhere. All 16 of the major sector funds we look at were in the green. We're talking everything from a defensive play like utilities, which was up over 1.6%, to consumer areas like home builders. It was a true total market rally. And here's the real kicker. All of this was happening while the news was just full of scary headlines. A US government shutdown was literally days away, new trade tariffs were in the works, and the market, it just didn't seem to care at all. It just shrugged it all off. All right, now let's hop across the globe for a completely different picture. In India, it wasn't a rally. It felt more like a perfect storm of headwinds that was causing a major sell-off. And wow, this chart right here really tells the story. You can see a few sectors were down, but just look at that massive red bar for the IT sector, a drop of nearly 8% in a single day. That's not a dip, that's a collapse. And it was so big, it dragged the entire market down with it. So what caused that IT nosedive? Well, it was a single policy announcement coming out of the US about H-1B work visas. This news was a direct shot at the business model of India's huge IT services industry. And investors, well, they reacted instantly and with a lot of fear. But it wasn't just the visa issue. It felt like the Indian market was getting hit from all sides. The US was also making noise about tariffs on its pharmaceutical exports. On top of that, you had big foreign funds pulling their money out of the country, and just this general feeling of global unease hanging over everything. Okay, so we've got two very different local stories. But to really understand why they played out the way they did, we need to zoom out. We need to look at the bigger global narratives that were shaping how investors everywhere were feeling. And during this week, there were really three big stories driving decisions. First, this growing belief that interest rate cuts were a sure thing. Second, you had money moving around based on geopolitical risks. And third, this surprising ability to just ignore the whole US government shutdown drama. So let's talk about that rate cut certainty. The thinking kind of went like this. Even though some economic data was looking pretty bad, like a surprise drop in private payrolls, investors actually saw that as a good thing. Why? Because bad news forces the US central bank's hand to cut interest rates. And lower rates, that's like rocket fuel for the economy and stock prices. So in this weird way, bad news was actually good news. And that mindset brings us right back to that US shutdown we mentioned. Investors were so laser-focused on the promise of cheaper money from rate cuts that the political drama in Washington, D.C. just became background noise. The market had basically decided the shutdown would be short and its impact would be tiny, a classic case of shutdown resilience. So how did this whole tale of two markets finally end? Let's take a look at what happened as the week wrapped up and see what history tells us might be coming next. So after 6 straight days of selling, the Indian market finally found its footing. It took a breath. By September 30th, things started to turn around. And guess who was leading the recovery? The very sectors that had gotten hit the hardest, like IT. It seems the panic was over. And if we look ahead, what does the data suggest? Well, this table shows the average historical performance for the next 2 trading days. And you can see that on average, both markets tend to see some modest positive returns in early October. For India's Nifty 50, that's usually a small gain on both days. Same for the USSP, the historical trend is also positive. It kind of suggests the worst of the turbulence might be over. Which leaves us with one last big thought. We saw how hard data, like a nearly 8% drop, can absolutely shock a market. But we also saw how powerful stories, like rate cuts are definitely coming, or don't worry about the shutdown, can completely override bad news. It really makes you wonder, doesn't it? In a world that runs on data, maybe it's the stories we all agree to believe in that are the most powerful force of all.